Over-the-counter, OTC, market. In the over-the-counter market, trades are done directly between two parties, without a central exchange or clearinghouse. Market makers are broker-dealers who quote prices from their own inventory and facilitate these transactions. This setup is common for bonds, derivatives, less liquid stocks, and crypto, but each party directly bears the other's credit risk. The OTC market is vital because it allows trading of assets that aren't available on standard exchanges, especially for larger customized deals. Institutional investors use it to trade big bond blocks without affecting prices, while hedgers rely on tailored derivatives like interest rate swaps. However, this flexibility comes with risks. Counterparty credit must be carefully assessed, and liquidity can be a challenge since these instruments are often hard to price or sell quickly. A corporate treasury with a $50 million floating rate loan hedges its risk through an over-the-counter interest rate swap with a dealer bank. In this custom deal, the treasury pays a fixed 4.5% annually, while the dealer pays a floating rate based on SOFR plus 1.2%, all on the same notional amount, with a tailored 3-year maturity and semi-annual payments. This trade could not happen on a public exchange because it's fully customized to the company's needs. For example, if interest rates rise, the fixed rate payer gains in swap value. This comparison table highlights the key trade-offs between exchange-traded and over-the-counter markets. While exchanges offer centralized trading with public prices and lower risk through clearinghouses, OTC markets provide flexibility through bilateral negotiation and highly customizable contracts. The main takeaway is that OTC instruments like bonds and swaps offer customization at the cost of less transparency and higher counterparty risk. When evaluating OTC market insights, start by comparing dealer quotes from multiple sources to gauge fair value, and always check counterparty credit risk through balance sheets and credit default swap spreads. Review FINRA trace data for historical bond trade volumes, but remember that price transparency is limited. Bid-ask spreads can be wide and non-public. Before trading any illiquid instrument, plan your exit strategy in advance to manage risk effectively.